So this is our focus and we'll discuss today. Shivam, can you just open the presentation? So the program structure will be, I will give initial points relating to this topic, that why this is important and why it is happening. And then I'll introduce the speakers and then Mohini will start. Okay. So friends, the issue is coming that why this ESOP trust route is becoming very popular and it is a growing trend. This is not because of some law, because of business requires today. And how and why, I just want to give a brief to all of you. Next. So forget the law. We should not thought about the law. First understand the business, that why it is happening. A company has 5,000 employees. So people join, people resign, other retire, option are exercised, option lapse, buyback happen, IPO happen, various PE investors are coming. So many things are happening. So if shares are directly issuing, then every time capital structure or our cap table is disturbed. And this is becoming really difficult, and someone has to manage this employee ownership concept. So you have this structure that is a trust, and under the trust, so many things are happening that can be managed, but cap table is showing the trust name. So actually the manager in the employee welfare trustees, they are acting like a warehouse, treasury, bankers, settlement agent, transfer agent, fund manager, and the important in governance mechanism. And one combined entity is working like this. It is not creating any ESOP. It is managing the ownership. That is the biggest difference, conceptual difference, which we have to understand when this discussion that how employee welfare trust works, how the trust route is there. This is happening because of this reason. Next. Now, the direct route is not fail, but it is now outgrown because system has becoming big. So now take example, there was a 50 employee, 20 got ESOP. So simple grant, exit, a few exit, one geography, issuing shares difficult, directly worked very well. So this route has worked because the scale was limited. Now see the new route, 20,000 employee, 8,000 ESOP holder, 40 countries, IPO, buyback, secondary sale, VC exit, equity, private equity, multiple rounds of funding. So the direct route simply become inefficient, and it will become inefficient. It is not that a small company can follow this, but the company are growing, they require this. So that's why today's discussion. So that's why trust route has evolved. It is not because of any law is saying, because of business is compelling you. Next. Now, the sixth generation of rewarding people, how it has happened. First, salary, pay for time. Second, salary plus bonus, pay for performance. Third is salary plus ESOP, that is a generation 3, pay the ownership. Now, next came generation 4, that is digital ESOP management, because number of people were there, they were asking how much money, how much progress has taken place. So the digital ESOP management system has come, ownership goes online. But now the trust-based ownership is slightly different. And here is the generation 5th, we are talking about this. So ownership is required one engine, and in future AI managed ownership will come. So today we are focusing on G5, generation 5. So let's understand that trust-based employee ownership is the operating model of this decade. So we have to just work out how we can do this. Next. Now, friend, what is happening here? The trust route is why this is popular, because momentum is taking place, not because SEBI has said, because business is saying. So there are 1,50,000 DPIT recognized startup. They cannot pay Google's app salary because they are a startup. They pay ownership. IPO boom is taking place. Listing bound companies need a clean cap table, predictable dilution, and structured administration. Then secondary sale is also taking place. Employee will not wait 10 years to monetize. They want trust to liquidate this vehicle by using as a vehicle who can liquidate their holding. Private equity fund, they want predictable ESOP pool. They want a stable cap table and controlled dilution. Employee expectation, they are not interested how many option. They are interested that how much and how I will monetize my this amount. So 5 different stakeholders, one common answer, the employee welfare trust. That is one solution which has come out. Next. So the rare structure that every stakeholder is talking, companies having advantage, CFO has advantage, HR has different advantage, board has different governance issue, investor they are seeing cap table visibility, employees seeing better administration, liquidity and confidence. The regulator is also seeing that you are available for complete audit and everything is there and manipulation will not be there. So alignment is the product. When all 7 agree, adoption accelerate. This is the new phenomena has created. Next. Now the 360-degree ESOP system, this particular thing. Here, employee, HR, NRC, board, company. Structure is trust and trustee. Professional advisor, merchant banker, valuer, auditor, tax advisor, technology partner. Market infrastructure, depository, stock exchange. Regulator, SEBI, MCA, CBDT, investor, proxy advisor, and judiciary because they do oversight. So 21 participants, one structure hold them together. That is the new scenario which is coming in the scene. Now, Bartika and Mohini will explain in detail about this. Next. Another point is one structure 15 business proposition that is also there. So one is secondary acquisition, treasury share, employee exit, buyback, funding, cap table hire, large employee base, corporate restructuring, M&A, IPO readiness, accounting, employee communication, administration, regulatory reporting, continuity. So this trust is not a compliance object, it's a business infrastructure, and all these things is need of our. So this one employee stock, the trust is, structure, this is solving 15 business problems can be solved by doing one way. Next. Then today we are India states. United States ESOP trust is ownership. UK employee ownership trust. German employee share scheme. Japan employee shareholders association. All is talking about the ownership. India trust route is mainly administration today. So we are doing administration point. Now India's thesis will be that we believe the next stage will be ownership trust, not merely ESOP trust. So when world treat this trust as a vehicle of employee wealth, then why India will not think on this? Next. Then come to some myths. People are thinking that this trust system is something, it is only for listed company. No, anybody can do. Trust route is expensive. No, it is easy and it is less costly. Myth third, trust route is complicated. It is not. Trust route is initially you can find you have to do something, but it is simplified. And trust is only compliance. No, it is not compliance. It's a structure. It's an infrastructure where everything managed properly. Next. The gatekeepers like proxy advisories are always opposing the ESOP and ESOP grant. When you give something, they have objection. So if you make that trust route, which is pure governance point of view, then what they can scrutinize: trust funding, voting right, related party angle, promoters benefit, dilution, transparency, independent trustees, disclosure, conflict of interest. All these things become very simple, and this is not something, because all these people, those who oversee, these are the gatekeeper, they borrow and they identify that if things are simplified, then their work is drastically reduced and they focus on different aspects. Next. Trust administration become technology driven. Now what is happening? This I'm saying today and it is developing, but I'm showing you the future. The trust will be this trust will become AI administration board, blockchain records will be there, digital trustee will be there, employee app will be there. They can see real-time tax calculation can be there, live valuation can also take place on the basis of company's performance, cap table intelligence will be there, workflow automation and predictable analysis that how much today and if the profit is going up, then how you can do so. Gaming system can also start. So the trust dashboard will be there where one-click compliance, one-click audit, one-click buyback can take place. This is the future. This has to be developed. So the winner of next decade will not sell trust seed. They will become who will sell trust infrastructure. That is the future. Next. A entire new industry will emerge. Now, I'm just predicting if this is happened, then what will happen? Corporate trustee concept will come, trust administration issue will come, trust audit will be different, trust rating will also start, trust funding will be a new phenomena, trust analytics will also be there, trust governance issue will emerge and they will come out differently. What I'm saying, it is not solving all problems, some new issues will come. So the regulator, the proxy advisory and company, everybody has to work out on some new things. AI administration, secondary marketplace where you can liquidate your shares and or they can connect with somebody who is providing this platform. Employee wealth management system can also emerge. So 10 services, one legal entity and highlight will be there that everybody is focusing for future and this is the future which will take shape. Next. If I sat on regulator chair and this trust system is so efficient, then if I'm SEBI, simplified trust funding, allow faster secondary acquisition, digital filing, integrated disclosure, I will do it. If I'm an MCA, standard trust document, I will allow, model trust deed, I will allow, online trust registration work will be allowed because system will be structured. If I'm in the I were the CBDT, remove taxation complexity because ESOP is always crying for taxation issues. Simplified trust sector transaction. If I'm in a RBI and the inter jurisdiction companies are there, people are there, then simple predictable FEMA framework for cross-border employee can also be bring out. So none of the requirement is law. It is all, it require regulatory intention. So there's no need of any new law, but they can changes like this. Next. So 2035 employee ownership platform. That is a prediction that trust will no longer be just a legal entity. It become the financial operating system for employee ownership. One digital ownership account will be there per employee, AI driven, where ESOP, RSU, SAR, Phantom, performance share, deferred bonus, co-investment unit, all will be integrated with payroll, taxation, DMAT, and compliance. So ESOP trust will evolve into employee ownership performance, every long-term incentive, and one dashboard. That will be the future. Next. So friends, in this point, the discussion is not direct route versus trust route. The real discussion is whether India wants to create an ownership economy, because that is the future which is taking place. And everybody is realizing that this ownership concept is giving fruits, making multi-billionaires, so many employees. And then these people are investing in other startup. So this is one chain cycle which is going on and it is creating something new structure. So trust route is only vehicle that we have to understand. The destination is in India where wealth creation is shared with employee, which was rare, but now people are doing. Governance will strengthen, talent will retain, and the companies move from paying salaries to creating owners. And it is not only salary, because I have so many companies which have seen that they are paying more ESOP, and because of ESOP, their ownership and their cost is reduced. So the future is not ESOP administration. The future will be employee ownership management. We have to travel to this part. Today's discussion is on this, but future is reaching to this way. So this is our today's discussion's main point. Now come to our speaker for today, which we have created. So the one of the strength of today's webinar is that we have a diversified our pool of panel. Each speaker represent different stakeholders in ESOP ecosystem. Shivam, can you open this? So now first we have Sonal Singh, Company Secretary and Compliance Officer, Urban Company. And Sonal is she is working she has over a decade experience in corporate governance, compliance, and corporate law. She was earlier in the Paytm, then she was working in Indigo, State Bank of India, Bharat Rasayan, NPSL Holding, handling complex corporate and governance matter. We welcome Sonal for this program. And the selection of Sonal is because the Urban Company represents new age digital platform economy, a rapidly growing technology-driven business where attracting and retaining talent is fundamental. And it will be interesting to understand from Sonal that how high growth platform company approach employee ownership. And she has so many gig workers also, so she can highlight on this. I welcome Sonal for this program.
Thank you so much, sir. Thank you.
Then we have Akshay Sethi, Jubilant Work for Foodworks. Akshay is Deputy Company Secretary in Jubilant Foodworks Limited for 15 years of post-qualification experience in corporate law, listing compliance, corporate governance, listization, corporate action, ESOP, dividend management, board committee, and various other things. Prior to this, Jubilant, he was in Tulip Telecom, and then he has worked in Jindal Power, he has worked in Sterlite Power Grid Company, and he's a law graduate, master company secretary, and he has extensive experience in SEBI, regulation, corporate compliance, and governance practice. Welcome, Akshay. And as you are aware, the Jubilant Workforce manages one of India's largest organized workforce, totally different from Sonali's company.
Thank you, sir.
And they have administrating ESOP in an organization operating at such high scale, bring unique governance and operational challenge. His experience will provide valuable insight into large listed companies' practice, that why ESOP and why. And when we'll ask questions, then these all things will also be identified. Welcome, Akshay, for this program.
Thank you.
Then we have Bhagshri. She's from Beacon Trusteeship. She is senior manager in Beacon Trusteeship with over 6 years of experience in relationship management, client service, and financial services. Thank you, Bhagshri, for joining us today. We welcome you. And
Thank you, sir.
today, when we have a listed company, one new age company, then the trustee is also here to whom we are talking. So we will have perspective of corporate trustee, and this is a particularly valuable because trustee views ESOP from the independent governance point of view and fiduciary relationship standpoint is very, very essential and important. So we will understand how trust should actually function and how trust will be an efficient mechanism for employee, company, and the governance point of view. Then we have Mohini Vaishnav. Mohini is a partner and head ESOP Insider Law Service corporate professional. And Mohini has advised hundreds of companies, listed, unlisted, startup, multinational. She has therefore witnessed the evolution of ESOP from across different industry. Her experience will bridge law, strategy, and implementation. And Mohini was a member of she has helped when SEBI came out with ESOP changes, and SEBI has helped Mohini has helped SEBI in detail, and her experience has worked very well for designing the new ESOP law. Welcome, Mohini, for this program.
Thank you, sir.
Then we have Bartika Agrawal. She is Assistant Manager, ESOP and Insider Law Service Corporate Professional. Bartika work closely with day-to-day implementation and administration. While strategy is important, successful execution ultimately determine whether ESOP scheme achieve some is object or not. So her role is very, very important, and we should understand that without understanding something, without understanding and execution, nothing can move, nothing can do this.
Thank you, sir.
So, Bartika, thank you very much. So, in a way, if you can see this, the platform economic lens, Sonali will say, the large listed companies lens, Akshay will tell. Urban companies also large are now, but Akshay is on a traditional way converting to this, will give some new highlight. Mohini will tell us on the advisor lens, and Bartika will tell us on execution lens, and Bhagshri will tell us about the trustees lens. So friends, all these discussion will take place. So before we start today's discussion, there's only one thought, and I believe the discussion is not only simple about the direct route versus trust route. The large issue is future of employee ownership in India, how it will take shape, and how the governance will improve, how this things can create something. So doing this, let's start today's discussion. But before starting discussion, I have to just announce our next 274th webinar will be on LODR regulatory updation. What are the changes taking place and what has happened, because LODR is always a live topic. So on 7th, we will meet on this particular topic. Till then, let's discuss today's topic. The structure will be, first Mohini will speak and give her point of view, then Bartika, and then Sonali, Akshay, and Bhagishri, they will cover their point, their organization point of view, and then we will have a question answer. Okay, over to you, Mohini. Just go over slideshow. Yeah,
Thank
Mohini.
you, sir.
Yeah.
Thank you, sir. So good evening, everyone. So today we are
Yeah, this is okay. Now okay.
okay.
Hmm.
So today we sir has rightly set the context that why the trust route is uh, now be under the consideration for various companies, either it's a startup, listed, unlisted, because of the change in the entire ecosystem of the ESOPs. We have in our earlier webinars, we have discussed on the types of ESOPs, how exactly the ESOP work, what exactly in the ESOP happens. So we all know that in the ESOPs, employee will become the owner in the company by holding the shares of the company. And it has a life cycle of grant, vesting, exercise, and then becoming a shareholder through allotment or by getting the shares of the company. But when it comes to that, how the company implement that particular process, there the decision comes to either it go through a direct channel to the employee or it uses the trust in between to channelize those ownership. So I am going to help you and I am going to cover today about that why the companies are now considering the trust structure in framing their ESOP process. So, as in the direct route, if we first understand that what exactly the difference between the two routes are. So, when it comes to the direct route, the company grant options directly to employees. So, to whom to grant, who are eligible, how much the pool will be, everything is planned through the company, and the company will issue the grant letters. Now, when the employee vests those options, it is also the company who is going to decide, because the conditions have been created by the company. And then the employee exercises those options when it gets vested. And then the company issue fresh shares to the employees by increasing, and when the fresh shares will be issued, it increases the capital base of the company. So it's a direct route. So there is no intermediary. Employee exercises and gets the shares through fresh allotment from the company. So these are only the fresh shares. When it comes to the trust route, here trust will act as a fiduciary and an intermediary channel from the grant to transfer the shares to an employee. In the trust routes also, the company may always have the same right that to whom to grant, what are the conditions for the granting, and what are the conditions for the vesting. Now, but these decisions are done by the company, but for administration of these activities, because it's not the one-time activity that I have offered the ESOPs to someone and it's the only the letter which I am going to give to the employee. It's the entire process need to be administered properly. Now, what happens is when we introduce the trust in between, the trust will administer the entire process. So the company gives the grant and then it transfers that information to the trust to manage the entire process. Now, when the employee exercises after vesting, he approached to the trust and the trust will transfer the shares to the employee. So before the employee transfers, the employee get the shares, trust is holding the shares in a fiduciary capacity for the benefit of the employee. So it creates a transparency also when it comes to the employee that my shares are in safe hand, and whenever I require, I can go and approach to the trust and get the shares of mine in my hand also. So when we compare the trust route or direct route, so the key components to consider in this is, first is who is implementing. So direct route is implemented through company. In the trust route, we create a separate employee welfare trust. So there are many questions comes to us whether the trust which we have for gratuity or for any other employee benefit purposes, whether we can use the same trust. So here the question is, the answer is that no, for the ESOP purposes, we need to set up a separate ESOP or employee welfare trust. But one trust can manage the multiple number of schemes. But we should have a one separate employee benefit trust managing the ESOPs. When it comes to the sources of shares, so in the direct allotment, only the source is the fresh allotment. So the capital always increase when it comes to the direct route. But when it comes to the trust route, the fresh allotment is also possible. And another avenue opens for the trust is that it can channelize the shares already in the market. That means already the shareholders can transfer the shares to the trust, and from there the trust can channelize those shares to the employee. So the secondary acquisition is also possible when it comes to the trust. Dilution, definitely whenever it's a direct route, every share creates a dilution. But when it comes to the trust, if we go for the secondary acquisition, there is no dilution at all. So the promoters also, when it comes to the dilution strategy, this what route we need to incorporate in that ESOP scheme, that becomes important. Liquidity support, if I check, then in case of a direct route, liquidity is always when the employee go and sell the shares on his own. But when it comes to the trust, so employee can directly give a direction to the trust to sell the shares on his behalf. So it gives a greater flexibility when it comes to the liquidity support. Funding requirement, when the direct route, in the direct route, funding is always employee has to manage itself. He has to bring the fund, apply for the shares, get the shares from the company. When it comes to the trust, because trust gets the funding done before the employee pays to them, because he has to acquire the shares. Now, when employee doesn't even have the fund, they can allow the trust to sell the shares and get the money fund arranged for the exercise and exercise those rights on his behalf. So this is how in the funding requirement also the trust helps. When it comes to the administration, yes, definitely trust route is comparatively simple. Trust require a governance, separate record mechanism. Suitability, if I talk, so then in the simple ESOP structure, limited number of employees can be managed easily because there are limited employees, limited exercises, can be managed easily in listed and unlisted both structures. But when it comes to the large number, strategically managed ESOP programs are there. The people and the exercise period is longer. Then that those cases, trust route is now proving a better tool or better route to manage this ESOPs. Cost, definitely, it's comparatively lower because no intermediary is involved, no fiduciary capacity person is required. But when it comes to the trust, a little bit increase in the cost is there. But when it comes to the vis-a-vis benefit, it benefits more than its cost. Now the next question comes to that why the listed company consider trust route or considering the trust route now. First of the key advantage always is a dilution management. Because as just we discussed that when we issue fresh shares, every time the dilution happens, but when it comes to the secondary market acquisition, no dilution will happen. When no dilution will happen, that means the promoter holding, non-promoter holding will remain intact because all the trust route will come in the non-promoter only. Then there is no dilution in the EPS also because no new shares we are issuing. So this will resolve the problem of dilution. When it comes to the share inventory, so definitely because in the direct allotment, we are not aware of that when our shares are going to increase. But when it comes to the trust route, we can easily build our inventory, which I can transfer in future to the employee when he exercises. So we can project the vesting cycle. We can design that how much quantity is required at each and every vesting. And we can avoid the repetitive allotment at every exercise cycle. Now, because the people who are working in the listed companies, they are aware of that whenever they have to go for the fresh allotment, they have to go for the listing of each and every trench at the stock exchanges. So once we have the trust in place, then we can avoid the repetitive allotment. And once we can allot to the trust, and then this administrative hurdles also get removed. Now, another important one, why now the companies are considering for the ESOP trust structure is the cashless exercise. Like we talked about the funding. So when it comes to, because now ESOPs are being given, the prices increase, the excise price the employee has to pay, the perquisite taxes the employee need to pay. All these require the fund. Now, employee either arrange the fund for themselves from its own sources or they go for some financial institutions for getting the funding done. Now, when it comes to the ESOP trust structure, then the cashless exercise mechanism, which is also allowed in the SEBI laws, there the employee just direct the company and direct the trust that am exercising, for example, 1,000 option. Please sell those shares in the market to an extent to arrange the funds for my exercise. So it helps in managing the cashless exercise and employee need not to think of that he has to arrange the funds. He can simply use this channel of trust for managing their exercise funding. Another important one, use of the secondary acquisition. Company, like we have talked about, the company already is a very well capitalized. The company share capital is sufficient and there is no requirement of having more fund in the company and issuing the new shares. So when we have already a tradable shares in the market, now the companies are using to channelize those shares itself to the employees. So for that, the trust is only the legal entity who can go and purchase the shares from the market, hold it for the employee, and then transfer it to the employees as and when the employee exercises. Now, when we come to the unlisted part, that why the unlisted companies are adopting for the trust route. So the first important point here also is the liquidity and cap table benefit. How the liquidity? Now, we all are aware that in the startups or in the unlisted companies, the funding rounds are happening very frequently. And in that, the funding round, when it comes, it also provides a liquidity or monetization event for the employee. Now, when it comes to the ESOP direct allotment to the employee, in that case, the company need to go into that particular channel that he has to issue the shares to the employee, then the employee will transfer the shares to the prospective buyer. But when we have the trust in between, we have only one entity to interact, and it's very easy to sell. It is very easy to manage those funding round, those buyback rounds through trust. Also, in the employees of the unlisted companies, there is no available market wherein the employee can go and sell the shares. So trust we can create for providing the liquidity to the employees as well. So this can also be managed through the trust. Otherwise, the promoter has to come forward himself for purchasing the shares from the employee. Now, when it comes to managing cap table complexity, so yes, because if we issue shares directly to the employee in the unlisted company, the number of the shareholders increase, and then managing those shareholders also in an unlisted company become a challenge in that case, because for all the journal meetings, for the voting purposes, investor due diligences, when it happens, a shareholders agreement need to be decided. Then in those cases, if we have the trust who is holding the shares or for the benefit of the employees, then trust will be acting for all the shareholders, all the employees as a one legal entity. So it helps in managing the cap table complexity as well. Other advantage, if I talk about, so yes, now the companies are coming with an IPO, and there is a very probable questions which the unlisted companies have, who is planning for an IPO, that what happens to my employee, whether my shares get listed immediately after IPO, how I can give a channel to my employee to get the benefit of the IPO. So here the answer lies in the ESOP trust. So that if planned properly, can be done easily. Lapsed and cancelled options. So many now, so in the lapsed and cancelled option, the people resigns when they from the organization. Generally, the company give them right, ki, okay, you just take the shares vested rights with you, and whenever the event comes, you come and have monetization done from your options. But when it comes to the shares, so the employee will take the shares. You have to search for the employee. Now, when it comes to the trust, so trust is holding those shares for the benefit of the employee. Anytime employee can, whenever the event comes, trust participates, and employee money is safe in the hands of the trust, and employee can get their money from there. So managing those lapsed options, the people who have resigned, the management of the shares will be easy in through the trust. Now, a single trust can administer grant across subsidiaries. So we can have a single trust structure for managing those things. And for managing the exit documentation like ROFR right, drag along right, clawback provisions, all these become easy when we have the trust. So is the trust route suitable for every company? Again, you have to evaluate considering your position. Like trust route may be suitable when there is a large employee population, secondary acquisition flexibility the company require, dilution management is priority, IPO planning underway, and multiple schemes are there. Direct route remain preferable for the companies where there is a small ESOP pool, infrequent exercises are there, fresh issuance, no problem. Trust setup cost, not they find commercially justifiable in that case. And simply grant to allotment process is the company only wants that process and no immediate liquidity requirement is there. So in those cases, direct route remain preferable. But when the company grows and the employee grows, then the trust route now become more suitable in those cases. When it comes to choosing the appropriate route, or the company, the management has to consider one by one the factors. Those factors are first define the purpose. Because when you are managing the scheme, you are designing the scheme, you have to define the purpose. What is the company's core priority? Then it compares the route, where the trust route is benefit or employee welfare trust, how we can use it, sources of share, that fresh allotment is required or secondary acquisition we want to channelize, or a combination of both is also possible through the trust route. Dilution, evaluate dilution, because existing share avoids further dilution. Then if that is the case, then you have to choose for the direct trust route only. When it comes to the scale consideration, because trust route supports better, larger exercises, because frequent allotments can be avoided. So the scale consideration, when it comes to, it is easy to manage through trust. Also, when the trust route is there, it is easy for the employee also, that the waiting period for getting the shares after exercise is also less, because when the direct allotment is there, the company has to plan that allotment accordingly. Many companies go for once in a month allotment process. Many companies go for quarterly allotments near to board meeting only, so that they can easily manage those allotments. But when it comes to the trust will help the employee to get the shares within the a smaller framework. Like the company can transfer the shares on a fortnightly basis or so. So it helps the employee in monetizing those things easily and faster manner. Hybrid structure also possible through the trust route. So when the company doesn't find it suitable to acquire the shares from any outsider, then the company can go for the fresh allotment. So both avenues become open for the companies when it comes to the trust route. Also in the unlisted companies, we have seen now many a times the agreement, shareholders agreement, whenever any VC or any private equity fund comes in the company, they say they will not dilute their part. They ask the promoters or the founders to dilute their part. So in those cases also, in this trust structure, it is possible, because when the founder can only transfer the shares to the trust, and other shareholders will remain on the same percentage in the cap table for the trust structure. Now, assesses funding capacity. So now when it comes to the what structure you have to go, here the funding capacity is important, because the question comes to help in this is that from where the funding to the trust comes. So when it comes to that, where the funding comes, so in the which the Vartika will be covering, that company is also is the funder to can provide the fund to the trust. So the company can provide the fund to the trust, and it is legal, it is covered under the Companies Act. But there is a certain requirement and a maximum cap up to which the company can provide the fund. So before you decide for the structure, you need to check whether that funding requirement for acquiring the shares, that can be funded through the company or not. If that route is that funding is not available, then the company has to think of whether they can arrange fund from other than the company, any other person, or they will go for the direct route. So this is also one of the important part when it comes to the funding capacity, which we need to, which make us to which route need to be adopted. Now, when it comes to the planning and managing the trust, because once you have the trust, you have to manage it, you have to plan accordingly. So first important step comes is the forecast share requirement, because the generally the question comes is that if we have a trust, how we plan, whether we allot the shares once when we go for the grant, or we can acquire we can have the shares in that trust later on, even because the cycle of the ESOP is not a 1 year or 1 month cycle. So we have a very longer period. So what will be the right time? So here the answer comes is that you have to forecast your share requirement, and deciding and which depends upon vesting schedules, how much the lapses are there, expected exercises, and accordingly you can have the shares in the trust. So it's not necessary that once in a one go you have to allot the shares to the trust. Prepare a funding plan, because I just covered that there is a maximum cap of getting the funding from the company. So when it comes to managing the trust, you have to also prepare a proper funding plan for that. Then maintain optimum inventory. Yes, because when the employee exercises, trust always should be ready with the shares to transfer to them. So we need to be very much careful when you are planning for that how much inventory the trust hold. You have to calculate it very wisely depending upon the vesting schedules which we discussed. And vis-a-vis also you have to be very specific that you should not block a larger quantity in the trust. The reason being, once you block the quantity in the trust and the employee doesn't turn for the exercise, then the inventory get blocked and you have to use it only for the benefit of the employee. Either the fund which you arrange from selling those shares, or when it comes to these shares as well. So don't block much larger quantity, but always your trust be the shares will be available with the trust to transfer to the employee. Share level traceability is easy, and whenever it comes to when you have acquired, when the quantity is transferred, that also you need to manage to the trust, and that's the reason the trust manages the entire separate record for each of the schemes and each of the acquisitions they make. Exercise patterns are very important because then you in the listed companies you require the all the listing and trading approvals from the stock exchange. So you have to analyze your exercise pattern when you are managing the trust. And last, you have to allocate clear responsibilities between the various stakeholders in the ESOP program, like what the role of the trustee is, how the HR will play, what the finance has to do, what the payroll, because exercise involves the taxation, so who will going to manage the payroll, secretarial teams because the disclosures are required, and the ESOP administrator for the seamless execution. So the closing takeaway, the trust route is not merely an alternative method of issuing ESOP share. It is a strategic vehicle for managing dilution, liquidity, share inventory, employee participation, and long-term ESOP governance. So the right structure depends upon company stage, size, and liquidity needs. Thank you. Over to you, sir.
Okay, Mohini, thank you very much. Now, Bhartika, please tell us, because Mohini has given the larger picture, when you execute this, why, when, and how. Please explain to us.
Yeah, is my screen visible? Yeah.
Yes.
Okay. So good evening to all the participants, and thank you, Pawan and Mohini ma'am, for sharing your insightful insights on the ESOPs via Trust Road. So if I talk about, we have read trust and everything every time we have heard, but what actually trust means? So if I just a second. If I say in a everyday language, trust basically means a confidence, right? But when we convert it and read it in line with the legal parlance, it is a specific arrangement, right? So in this arrangement, basically the settler, who is a company, transfers the property. Property is here shares to a trustee, and who holds and manages it not for themselves, but of course for the beneficiaries, who are the employees. So in this structure, in the slide, as we can see that there is a divided ownership, right? And the trustees, they hold a title, but the ultimate beneficiaries, the employees, will receive the economic benefit. So creating a structure, a simple structure, is the foundation of everything. If we discuss today who owns the shares, who receives the benefit, and to whom the authority is there. So trust over here is, of course, firstly governed by the Indian Trust Act 1882, and rest the company settles it and in the favor of the employees. In this slide, we can see that why the structure has been increasingly relevant in the market. So we can see that now these long-term incentives are, becoming the mainstream strategy in the compensation structure now. Because as a survey that is shown on the slide done by the GT, it shows that from 63% in 2020 has been risen to 75% in 2024, with the 79% compensation structuring via ESOPs in the technology, media, and telecom sector. So the main reason is that the reasons of these are quite very practical, which says that companies are preparing themselves, as Moni ma'am has correctly said, that companies now they're preparing themselves earlier for the funding rounds or the IPO along with the liquidity events. And yes, they want to document everything to showcase the investors the clear-cut picture of a cap table. So now from this slide, we can see that the question is not whether to introduce ESOPs or not. Rather than the sharper question over here is that the what and which structure is more suitable for the company, which will continue as the company will grow. So here in this session, there's a one practical questions, that is how to use the trust route. So first we'll discuss on setting up or structuring the welfare trust. What are the pre-formation requirements, the governance, the implementation methods, what clauses should be used, how the funding will be governed, and so on. Next structure in this, I'll be covering the legal and the regulatory framework. Because the Companies Act and the SEBI regulations, the PIT, FEMA, these all will come into picture. So the point over here is that not to begin with a trust deed, but to begin what the company actually requires, what the company actually needs. So the decision is very much to be settled before we start anything in writing in a document, or even before any trust transactions begin. Mohini ma'am is correctly very detailed. She has covered that why are the companies, bringing the trust in, is more prevalent in the market. These are the major 6, the decisions that should be quite clear. The entity profile, the mode of the acquisition of shares, primary, secondary, or hybrid of all. And then the third is the pool size, the scheme, the funding, how whether the company or the funders, the third party institutional investors, financial institutions will give, or how. And the fifth, whether the individual be the trustee or the corporate. And lastly, how the exit to the employee will be given in case of unlisted companies, and in case of listed company, whether the cash or a cashless mechanism, that is sell to cover, will be used. So these all are basically the connected decisions. Once this design is clear, the authority to whom what should be the authority given should also be very much clear. In this hierarchy, we can see that the shareholders, they approve the scheme, the route, the limit, and everything. And even if the extension is required or secondary shares to be taken, all the necessary approvals which require the special resolution will be taken care of by the shareholders. The board and the NRC, they work upon the eligibility, the grant size, exercise, the conditions of the vesting, and other terms. The trustees, of course, they are the legal title holders of the shares, and they execute on the valid instructions that received from the company. And lastly, the service providers, the banks, the depositories, they help in the operational activities. So over here, the point is that the shareholders will authorize, the board and the NRC will decide, and trustees will act. Once it is done, the point to be noted here is that the trust deed should expressly, it prevents the trustees from taking any independent decisions with respect to the eligibility of the pricing. Those are the compensation decisions, and that has to be rest with the company committee and not with the trustee decisions. When these roles are clear, the implementation can be more defined in manner. So steps, I would say, in the structuring as we discussed by the Mohini ma'am, and in this present PPT as well, that how the structuring, like the primary or the secondary will be taken, acquisition, and approvals once discussed, like the board or the NRC shareholders is done, we need to execute. Execution and registration means to, a drafting and everything should be priorly completed before the approvals. Once all this is done and approvals are received, we need to move with the execution of the trust deed and register it with the sub-registrar. The fourth is to make the channelize, to operationalize the setup, like the PAN, TAN, the DMAT, and the for listed companies, broking and trading accounts as well. And fifth, once everything is done, the funding approvals are taken and to acquire the shares from the company or from the market. So these sequence of matters should be clearly there to avoid any gap or inconsistency. And after that, this is very important to look into it. The trust deed is a document which connects all these pointers. So if I talk about what are the very important and the non-negotiable clauses of the deed, I've taken 6 major pointers over here, particularly main. And the first is that the irrevocability of the trust. It has to be, and it has to be only for the employee benefit only. Second is the class of beneficiary should be clearly defined, because the class of beneficiary will be governed by the scheme and written in the deed, and not merely from the deed itself. It cannot be governed. The third is the trustees qualification. Over here means that who can be the trustees, and what appointment, their replacement, or conflict if arised, how that will be resolved. Fourth will be the funding provisions. Should be explained properly, like of course the company can pay, what if any donations or contributions can be made by the third party, and how that be used, being the income. Fifth is of course that the listed companies trustee cannot vote. It is barred and is banned that the trustees cannot vote. The only point is that to avoid to be used this voting for the management purpose, this has been strictly prohibited. And lastly, how if in case trust come to the resolution, any surplus, be it of shares or the funds, how that will be used for the welfare purpose, are the major clauses should be made in the trust deed. Apart from that, other pointers can be like the rights and liabilities of the trustees as well. Now, as we discuss the funding points, how the funding will flow. If I talk about the financing architecture of this ESOP trust, the trust do not have the operating income. So the company will of course provide the funding for the public companies, and the listed companies. Section 67, which is read with the Rule 16 of the Share Capital Debenture Rules 2014, they give an exception for these employee benefit that company can extend a loan provided they have the requisite approvals of the shareholders. Ceiling, as shown on the slide, is that the 5% of the paid up plus free reserves. And trust then can use it for the primary or secondary acquisition or both. And the loan, of course, is not automatically the immediate compensation expense in the books of the company. Rather, it is recorded as the amount recoverable from the trust. And private companies are exempt from 67. And for them, it's a separate funding analysis can be done rather than the blanket assumption that they can be given a loan from the company without any limit. So the point is the point over here is that the 5% limit is only applicable within the company if they are extending the loan. From the outside, from the third party, from the banks, there is no such limit. So over here, from this slide, we can say that funding will create a capacity. And next, how the shares will be sourced will be used for the employees. If I talk about the acquisition model, we can just a second, yeah. How the ma'am has covered in detail already the primary issuance by the company, and it will of course dilute the equity base, and there's no limit on the fresh issuance by the private or unlisted public or be it listed companies. And the pricing, how much price should be given to purchase in the case of primary issuance will be fixed by the board, because the price at which the options are given to the employees, in the same way, at the same price only, the shares are allotted to the trust, because that will only be recoverable. Unlike in the secondary acquisition, The sources are from, of course, the if in case of listed company, the market, and in case of unlisted, the existing current shareholders can also be transferring their shares. The point here is of the limit. In case of listed companies, it's 2% in aggregate, 2% in annually, and 5% keeping all the the employee incentive benefit schemes, be it ESOPs or everything, ESPS, it cannot exceed more than 5%. Lastly, if I talk about the pricing, the price, of course, for the listed companies, it will be the market price. And if in case unlisted company, it should not be the minimum fair market value that has been calculated as per the Income Tax Act. At that price only, the shares can be transferred from the current shareholders to the trust. Okay. Next, if I talk about the taxation aspects of the trust, tax should be viewed from the trust level and the employee level. So trustees here are the the fiduciaries. They are not personally liable for any income tax, first of all, and because they're only holding these shares for the benefit of the employees, cannot be held liable for the tax. But yes, any income by way of dividend before any shares are transferred, or any contribution given to the employee to the trust, is examined in the nature and is the income of the trust, and it will be that income will be taxable in the hands of the trust. And if I talk about the employee perspective, of course, this is taxable at 2 stages: the perquisite at the time of getting the shares upon exercise, and second is the capital gain when the employee transfers the shares. The most important point is that the trust route changes the delivery mechanism, but it will never change or escape the employee's basic tax that is applicable on the trust. Last point important is that the keeping trust is irrevocable, because the trust is irrevocable in nature, so it protects it from income being clubbed back to the company under the Income Tax Act. Discussing on the taxation aspect, after this, the very important pointers that I have come across are the accounting. How the accounting will change if the trust is there in the company structure. See, accounting story has majorly 4 steps. And first, the company will lend the fund to the trust, and the trust will use it for the acquisition. At this stage, there is no immediate employee compensation to be booked in the accounts of the company, because this is just a loan disbursement. And so we can see that booked as a loan to ESOP trust, and as an asset side. Second is during vesting, the employee compensation expenses recognized over a vesting period, and with a corresponding ESOP reserve that the company has created, because this compensation will directly hit the P&L. The main important point is that this is a non-cash expense, and it reflects somehow directly, I would say, it shows that what the benefit the employee is getting when the cost is being booked by the company. Third is how this accounting will be closed. So on exercise, the employee pays the exercise price, the relevant reserves are utilized, the shares are transferred to the employee, and whatever the available funds are there with the trust, that will be repaid to the company. And how this loop will be closed, because when the options so once these entries set off, when the employees actually exercise happens. And lastly, if where options are lapsed or expires, the reserve will be dealt as per the reclassification within the equity. As you can see that they are not, just a second, I'll show. Yeah, this will be if options lapses or exercise, it reserves isn't refunded or booked as a loss, rather it moves to a general reserve for the future corporate purpose. And yes, the grants often vest in tranches, so the loan and reserves will close progressively as the vesting and the exercise will happen. As you can see that this structuring and the operating model is clear, we can go and move ahead with the legal requirements in the framework. Because see, the ESOP trust is a layered structure. So different laws and different laws will govern it, different pointers of the ESOP trust, be it the formation, funding, market, taxation, anything. So one transaction of ESOP trust will have a multiple rule books. So the regulatory, if I talk about the regulatory map, there is not a single law that governs the trust. Rather, the Trust Act, the Registration Act, the State Stamp Law, and of course, the mother law, the Companies Act, governs the ESOP trust. Section 62 and the section 67 governs the be it listed or unlisted companies. Where the company is listed, they have to comply with the securities law, namely the SBB Regulations 21, along with the LODR for the for the outcomes and the market outcomes to the exchanges, and the PIT compliances being the insider trading compliances, because the shares of a listed company will be traded as once it's allotted. And in case the cross-border transaction, if to the employees of the if the NRI, the non-residents of Indian, are given the ESOPs, then FEMA and will come into picture. Okay, if I say section 62 says that we need to have a shareholders approval, which is a special resolution, and mandatory 1 year vesting is mandatory, and these options are not transferable to anyone, and it's it's the income of the employee. They only have a right to hold it and cannot be pledged even. And lastly, the SH6 has to be maintained by the company or the trust. Trust will maintain its own account, like employee-wise or the scheme-wise. But lastly, the SH6 has to be maintained by the company. Where the public companies come into picture, the funding will have to be done as per Section 67 and Rule 16, which adds us again separate layer of approval with respect to the funding. And you need to disclose the trustees, the funding terms, the employees, the shares covered. Everything has to be given in the explanatory statement once we go for the approval before the shareholders. The second, being listed company, they have be the listed company, they have to follow the listed entity mandates as per the SEBI regulations, SEBI SBB regulations 2021. So the main pointers compliances having a trust will be like either they can have an individual trustee or the corporate trustee. Individual have to be minimum 2, and alternatively a corporate trustee will be 1. Other than this, directors, KMP, promoters of the company or its group, their relatives cannot be a trustee of a trust. Also, a person any holding 10% or more as a beneficial ownership is also barred from acting as a trustee. And trust holding shares cannot vote in a listed company, because as I already told, that this prevents the employee benefit inventory from being used for the indirect management voting purposes. The lastly point is that the 25% of the minimum public shareholding is mandatory, because these shares are shares held by the trust are classified as the non-promoter, non-public. Therefore, the trust when they buy from public, the public float will reduce. So any company, listed company, near to 25%, they should check the model before the secondary execution. Next, if I talk about the timing, how much and when it can be purchased. So there are 3 major numbers. There's 2%, 5%, and 6 months. 2% will be the annual acquisition limit prior to the financial year end, and 5% is the aggregate of all the considering all the incentive plans, ESOP, equity linked incentive plan, and 6 months is the minimum holding period before the shares can move out. See, 6 months rule effect operates because listed companies often need acquisition. So to maintain 6 months holding period, the listed companies should have an acquisition calendar with them. This will help them when to purchase and how to purchase before the vesting or the exercise event occurs, rather than purchasing after the vesting or upon receiving the exercise application. And trust cannot trade in the derivatives, and every secondary transaction has to be on a delivery basis. So even shares should have a purpose. It is not that to trust is there just to purchase the shares on the market and to hold it. That inventory has to be properly backed by the grant in a subsequent financial year. This slide shows how and for what purpose the trust can transfer the shares. If I talk about the permitted off market or the sell scenarios, of course, to transfer the employees when they exercise. The other that ma'am has already covered, to sell to cover in case of ESOPs and for funding their exercise price and the TDS or transaction cost. Tendering into open offers, buybacks or delisting. Selling can be done for the repayment of loan and settlement. See, and this last fifth point is about a settlement of SAR execution. If appreciation has to be paid to the employee via SAR, this has to be properly duly noted. And all the shares can be sold for the settlement of the SAR. And when and selling can also be done if the trust has to be wound up. If I talk about the PIT, the other applicable laws for the listed company, it is the PIT regulations, prohibition of unsanitary regulations. The trust has to comply the disclosures with the requirements of the SEBI PIT regulations as is applicable on the insiders and the promoters. Purchase and transfer by the trust can only be done when the trading window is open. And to purchase on the market and to sell in the market, trust should properly take a proper pre-clearance. So yes, grant and exercise is exempt from the PIT, but actually trading in the shares by the employees once they receive it is governed by the PIT regulations. And once you employees of the foreign subsidiaries are covered, then the FEMA will take place like for the issuance of the shares or the offer of grant of options to the non-residents employees on a non-repatriable basis. The ESOPs filing at the time of grant form ESOP, and at the time of transfer SCTRS is mandatory to be filed on repatriation basis if they have been issued. These are just for the quick reference: 1 year vesting, 5% capital of loan of reserves and everything. This is something
Vartika, I think this is
we have discussed.
simple. Yes. This timeline, another thing.
Sure, sir.
Yeah.
Apart from this, so I'm just wrapping up. So this is not somewhere written or published in the market. It is from the experience, which I can say that in the early stage on the unlisted companies, 78% go with the direct route, and 20-25% mostly at a later stage go for the IPO. And when companies matures or something, then public or listed companies we can see that are going towards 60-70% with the direct route and 32% towards the trust route. These are some prominent companies who are running the dedicated trust, ESOP trust, Zomato, Infosys, be it manufacturing, IT companies, all of them are being using. Sir has already covered, Pawan sir discussed some myths. I've just added on some few more myths that one trust can run only one scheme. That's not correct. It can run a number of schemes, and you need to have a separate private ESOP trust for the employee welfare. And once loan is given to a trust for the fund to fund the acquisition, it's immediate cost. Rather, it's not immediate cost. It's a loan to a trust to be booked over the asset side. And any unclaimed shares or the lapsed options allow the companies to increase their profit. However, it is not like that. The lapsed option can be channelized for the future grants as well. And trust holding the trust held shares are covered in the public shareholding. It's not correct. It's non-promoter, non-public. So this was all from my side, and over to you, sir.
Okay, thank you very much. Thank you, Vartika, Mohini, for giving exclusively and illustrate. Now, over to the industry and those who are managing them. I will start with Sonali. Sonali, first of all three two speakers, they can tell us that whether you have trust or whether you are in the process of making trust, or what you feel that these things will be beneficiary. And because Sonali, your company is platform based, technology based, so you have a unique people, okay, and a unique challenge as compared to Akshay's company. And so if you think that this trust route can become relevant to your organization, and you can start with your thought process about this.
Thank you, sir. I think before I will touch upon the topic, I would like to thank Pawan sir for organizing the seminars on an ongoing basis. I feel like initiative like these, provide an excellent platform for learning, knowledge sharing amongst the professionals and young company secretaries. So thank you, sir, for that. And like Mohini and Vatika, they have already shared a very insightful presentation covering the implementation of ESOPs through direct and trust route. They've very clearly called out the process, what are the practical considerations, the benefits under each approach, and setting the stage for an engaging discussion and taking the Q&A. I will also share my thoughts about it. So to answer to Pawan sir's question, yes, we have recently implemented our ESOP structure through a trust route. Earlier we were following a direct route process, and we have very recently took shareholders approval and modified it to trust route. What I have seen, sir, in my experience, and what I feel is ESOPs have, evolved from just merely being the compensation tool. It's becoming more of a strategic instrument, which helps in fostering employee ownership. They allow employees to participate in the value they will create, aligning individual success with the long-term growth of the organization. And I feel this shift has been driven largely by the new age and technology led companies where people are the most valuable assets. Unlike traditional businesses that rely heavily on physical assets, these organizations derive their competitive advantage from innovation, intellectual capital, and entrepreneurial talent. So, as a result, attracting, retaining, and motivating talent has become a strategic priority, and ESOPs have emerged as one of the most effective ways to achieve this. Interestingly, you will also notice that these days employees' mindset have also evolved. Particularly in startup and a technology ecosystem, employees are looking beyond cash compensation. They're willing to participate, and accept a well-balanced remuneration structure that combines salary as well as equity, recognizing that ESOPs provide an opportunity to participate in companies' growth journey and create a long-term wealth. So I feel this alignment of interest between the employees, founder, and shareholders foster a stronger sense of ownership, accountability, and commitment. I think at the same time, the nature of work is changing. Organizations today operate with a very diverse talent model comprising employees, gig worker, independent professionals. While I understand that today ESOPs, the current legal framework of ESOPs are generally available only to eligible employees and directors. I think the broader philosophy of ownership, engagement, and value creation has been increasingly relevant across all workforce models, and that has been evolving over a period of time. Companies are therefore exploring to deepen engagement and build long-term partnership with the people who contribute to their success. So I think as ESOP programs mature, organizations also face a strategic decision whether to implement the ESOPs through a direct route or through a trust route. While both are recognized under SEBI laws that, like Mohini and Vatik also touched upon, they differ significantly in terms of governance, administration, and funding. Also, the employee experience and long-term flexibility. So at a higher level, I would say direct route is something we all understand where the company issues fresh shares directly to the employees upon exercise of vested options. And this model is relatively simple, works well for a smaller ESOP program. Whereas under trust route, an employee welfare trust acquires or holds shares and transfers them to employees upon exercise. Although it requires a stronger governance framework and a greater administrative oversight, it also provides significantly greater flexibility for companies with large recurring or long-term ESOP plans. And I think the trust route enables centralized administration. It needs better dilution planning, quicker settlement of exercises, and a more scalable operating model as the ESOP plan grows. So to share my experience at Urban Company, we transitioned from direct route to the ESOP trust route was largely driven by a long-term vision of creating a scalable and employee-centric ESOP framework. One of the biggest benefits we experienced was a significant improvement in the employee exercise journey. Under the direct route, like we all understand, every exercise requires a fresh allotment of shares. This involve obtaining necessary approvals, completing statutory filings, crediting shares to the employees' demat accounts, completing the related corporate actions, and therefore the further actions. As a result, I think the timeline of every exercise was linked to the company's allotment cycle and the statutory processes. When we move to the trust route, the employee welfare trust already holds shares. So once an employee exercises the vested options and complete the required formalities, the trust can transfer the shares directly to the employees, and this substantially reduce the administrative steps and enable a much faster and a smoother settlement process for us at Urban Company. For employees also, it meant quicker access to their shares and a significantly better experience. So I think for the companies, for us, standardizing and streamlining the administration, better planning of share issuance and dilution, greater operational efficiency and scalability to manage increasingly exercise volumes without proportionately increasing the compliance burden has been the key experience. And I feel trust route is not just a compliance or a governance enhancement. It's also a meaningful improvement in the overall employee experience. And I think one thing which Mohini also touched upon very briefly was a cashless exercise. I feel cashless exercise nothing but enhancing employee experience. A trust structure can facilitate the cashless exercise mechanism, obviously subject to various ESOP schemes, compliances, regulatory requirement, etc. So what happened traditionally, employees exercising ESOPs were required to arrange funds to pay the exercise price, bear the applicable tax liability before receiving the shares. For many employees, particularly the young professionals, this upfront cash requirement became a practical barrier to exercise their options. Under cashless mechanism, what happens is basically it addresses this particular challenge of having the funds beforehand. Under this model, the trust facilitates the exercise and the sale of required number of shares. The sale proceeds are used to recover the exercise price and applicable taxes, and the balance proceeds are paid to the employees. As a result, the employees are not required to arrange substantial upfront funds merely to exercise these options. And I feel this is one of for a company like us where we have a lot of young professionals, this has benefit, this has benefit us a lot. So this we have seen as a very very positive upgradation in our ESOP implementation structure. So yeah, I think before I conclude, I would say the trust route is much more than an alternate method of implementing ESOPs. It's a strategic governance framework that supports long-term employee ownership while also balancing operational efficiency, regulatory compliance, and shareholder interest. I think at UC, it helped us to continue, evolve when talent expectation change. ESOPs will always remain an important tool for attracting, retaining, and rewarding talent. And the implementation model, therefore, I believe, should not only meet the regulatory requirement, but it should also deliver a seamless employee experience, which we have experienced once we moved into a trust. Obviously, there were certain challenges and certain nuances additional in the trust route also, but I think I would say this has eased and the entire process for us and also enhanced the employee experience. And I feel a well-structured employee welfare trust should always be backed by a strong governance and a robust compliance and efficient processes, which is very, very important. And it enables the organization also to build a scalable ESOP plan, which ultimately benefits the employees as well as the shareholders alike and the company. So yeah, that's my view on the topic.
Thank you, Sonali. I will come back again
Yeah.
with various questions, which is marked to you before going. So one way the new age technology company now come to the traditional but broad-based company, listed company since so long. You have started with your life with the ESOP. They have given ESOP later on when the things are. Akshay, your turn. What is your, because you have a very large scale company with thousands of employees, how does a trust route help in managing governance, consistency, and operational efficiency? That is my question, but you can start with your own thought.
Thank you. Thanks, Pawan sir, for the enlightening presentation and Mohini, Vartika, and Sonali as well, I think, for covering this topic in detail. And while I believe there is, you have covered each and every topic in detail, and there's nothing left for me, but I'll still try and share some practical insights that I have, experienced over my journey with the ESOPs. So as you rightly said, while in JFL we have introduced the ESOP schemes from last almost 16 years now. Initially, we started with a direct route scheme, and then gradually, I think in the last 9 years or so, we moved to the trust route, and now we are administrating multiple schemes with the trust route. And last year only we introduced a new scheme, and therefore, from an implementation perspective, I think it was very easy to add a new scheme altogether when we have an existing trust setup. So, and therefore, for companies, who wants to have multiple ESOP schemes, a single trust facilitate this, adoptions in a seamless manner. Uh, while, if we see the journey of an ESOP scheme, I think we will start first with that, whenever a company wants to, launch an ESOP scheme, I think the first decision they want to have is whether to go for a direct route and or a trust route, which needs to be decided upfront at the time of seeking the shareholders' approval. So as you rightly said, sir, and which Moini has also covered, it depends on, if you want to target a smaller audience and, also the grant frequency and the exercises versus if you have a large structure and you wanted to have a large talent pool and where there are frequent exercises, then, definitely trust route is a preferred option for this company. And if once you have chosen a trust route, then obviously there are series of shareholders approval that you need to take. For implementation of the scheme, then authorizing the trust for secondary acquisition, then ensuring the funding arrangement that is there, because ultimately the trust needs fund to purchase the shares. Once this framework is in place, I think the real journey of trust starts. And let's see it at a grant stage. So one of the common question that comes, is whether the trust can buy shares, even when the options are not granted, and the company has just launched ESOP scheme. Well, my view is that the trust can buy shares in anticipation of the future requirement. I think this is the one of the key benefits of having a trust route, and ultimately the NRC committee, while looking at our future grants, continuously communicates with the trust and share the grant requirement. Basis this, the trust goes ahead and plan its inventory and goes and buy the shares from the market. Another question, would come from here is that whether the trust can hold these shares for an indefinite period. So there is just a provision in the regulations which says that, while you can go ahead and, the trust can go ahead and buy shares, in the market based on your future requirements, but then at the same time, there is a period defined. So these shares have to be backed by a grant, for a period of 1 year, and with an NRC approval for another subsequent year, second year. So beyond that, you cannot hold a surplus inventory, and you need to offload these shares. Now just imagine that a company like us, or maybe a large company where you have a multiple schemes running together, multiple grants happening at the same time, multiple people exercising. There are exits in the organization as well, so there are lapses. So all these things run simultaneously. So therefore, while trust route gives these flexibilities of seamless exercise and transfers and all, but then at the same time the trust and trustees work increases significantly. They have to continuously monitor the funding required, the inventories, the future requirements, that they do not have an excess inventory if they have to take an NRC approval, or they have to go and sell the shares in the market. So this is one of the aspect that comes with the trust route. Uh, Secondly, sir, I think at the time of exercise, definitely the trust, the employee will have to fund the exercise price to the trust and percolate to the the company. So and therefore these need to have a separate transaction for the company. For I think for the employee, this is the only difference versus the direct route and a trust route. Rest, I think the experience from an employee perspective remains the same. Apart from that, the timelines for the credit of shares for employee are significantly reduced in case of a transfer of shares from the trust route. Because historically, for a direct route, you have to wait for a corporate action, then go for a listing of shares. Typically, it may go up to 7 to 10 days, whereas in a trust route, it could be done within a span of minimum 1 to 2 days, depending on the signatories and all those things, procedural formalities. One practical challenge that I have seen in the trust route is that, and probably that has come as lately with the SEBI introduction of the freezing of the demat accounts once the trading window is closed. So if an employee exercises, let's say just on on let's say 30th of July, or today, and or maybe let's say 29th of June, or 30th of June, and when the trading window is again closed from 1st of July for your quarterly results, and typically the employee will have to wait for these shares to get credited in his account, because the demat account is freeze. But then unless the demat account is unfreezed by way of a specific exemption provided in the depository. So I think that is what a practical aspect. But I think to sum up, so I think I'll again try to say that direct route is beneficial when simplicity is the objective, but trust route is preferable when you want to have a scalability, flexibility, and also you want to have a long-term administration of employees ownership program. So I think so I'll sum up with this.
Akshay, just tell me, in case another listed company of similar size asks your advice, under what circumstances would you recommend the trust route? What will you say?
So, sir, as I said, so it all depends on if your target employee retention pool that you want is very small, and there are you don't have or unless you have an annual grant or you have a very frequent grant. So if you have an annual grant, then I think you should go for a direct route. And also, if you don't want a dilution in your shareholding cost, that is also one of the added advantages in a trust route. Whereas, if you want to target a large pool, you do not have any issues, with the exercises and all, and therefore, and also want to save your shareholding, no dilution, then go for trust route.
Okay. Bhagshri, now two companies we have heard, advisor we have heard, but now come to the trustee. So you are managing trustee ship services. Just tell us what is the trend going on and your views on the about subject. Over to you.
Okay. I will be just sharing my presentation. Is my screen visible?
Yeah.
Oh. Good evening, everyone, and thank you for having me. It's a pleasure to speak with you today on a subject that sits at the integration of corporate law, taxation, employee welfare, the ESOP stock option trust, and the ESOP trust. The earlier discussions have covered the direct and the trust routes. The reason companies may choose the trust route, the process of setting up an employee welfare trust, and the governing legal framework. I will therefore focus only on the practical role of the corporate trustee after the structure has been decided, how the trustee supports, control execution, administration of the trust, record integrity, continuity, and coordination among the parties involved in the ESOP process. An ESOP trust is a vehicle many companies use to acquire shares once, either through fresh issuance or a secondary market purchase, and then hold and transfer them to the employees over time as options vest and are exercised. It is also important to keep the boundaries clear. Now let us see what are the do's and don'ts of a trustee. A corporate trustee does not design the ESOP scheme, neither does it identify the employees, neither does it decide the number or terms of grants, nor determine the vesting or replace the authority of the board or the nomination and remuneration committee. Its role is to administer the trust and implement duly authorized decisions in accordance with the trust deed, the ESOP scheme, documented instructions, and the applicable law. Let us now see few scope of work. First point being the independent and controlled administration. The first role is to bring an independent and process-driven layer to the administration of the trust. Independence here does not mean that the trustee has unrestricted discretion or can override the company or the committee. The trustee remains bound by the trust deed and the scheme and acts on instructions issued by the authorized persons. The value of this segregation is that trust transactions are processed through a defined institutional framework rather than informally through individuals associated with the company. Before acting, the trustee can check whether the instruction is complete, comes from the appropriate authority, is supported by the required approvals and documents, and falls within the permitted scope of trust. A corporate trustee generally works through documented approval matrices, maker checker controls, authorized signatories, restricted access to bank and demat accounts, and escalation procedures. These controls help reduce the risk of an incorrect, duplicate, unsupported, unauthorized transactions and create a clear record of who instructed, who reviewed, who approved, and executed each action. Where an instruction is incomplete, inconsistent with the available records, or appear to fall outside the approved framework, the trustee should pause the transaction and seek clarification rather than overtake the commercial or governance decision. Let us now see the second point, which is administration of shares, funds, and trust account. The second role is the day to day administration of the assets held by the trust. This includes facilitating the opening and operations of the trust banks, DMAT, and where required, trading accounts, and ensuring that funds and securities move only through the accounts maintained in the name of the trust. Depending on the structure approved under the scheme, the trust may receive shares through a fresh issue, acquire shares through secondary acquisition, or receive shares through another legally permitted mode. The trustee coordinates the transaction, holds the shares in the trust demat account, and ensures that the relevant approvals and transaction documents support the acquisition, custody, transfer, or sale. It also monitors the trust's cash and share position, including the bank balances, demat balances, share inventory, exercise receipts, sale proceeds, loan movement, dividends, and other corporate benefits. Any amount or benefit received by the trust should be accounted for and used only for the purpose permitted under the trust deed and the scheme. When employees exercise vested options, the trustee acts on authenticated exercise data and instructions received through the agreed process, coordinates the receipt of the exercise price and applicable tax or funding information where relevant, and processes the transfer or sale of shares after the company confirms that the applicable conditions have been satisfied. The distinction is important. The trustee executes the share transfer and funds the transaction in case of cover to sell, while the determination of the employee eligibility, vesting, exercise entitlement, and the commercial terms of the grant continues to remain with the company or the committee. Let's move on to the third point, that is governance, record, and reconciliation. The third role is to maintain a reliable record of the trust administration. A corporate trustee maintains the trust books of accounts, minutes, and resolutions of the trust meeting, bank and demat records, transaction instructions, approvals, supporting documents, and a complete trail of the shares and funds handled by the trust. Where one trust administers more than one employee benefit scheme, its record should be clearly identify the transaction, assets, liabilities, and financial positions relating to each scheme. This segregation is important because a combined bank or demat balance cannot by itself explain which shares or funds relate to which scheme or employee benefit pool. The company continues to be responsible for the statutory and the scheme records applicable to it, including employee-wise grant, vesting, lapse, and exercise information, and the registers and disclosures required to be maintained or made by the company. The trustee's role is to reconcile the instructions received from the company against the trust's actual shareholding, funds, transfers, and pending transactions, and to flag differences before they result in an incorrect transfer or reporting issue. Periodic reconciliation should cover the option or exercise data shared by the company, shares held by the trust, transfers completed or pending, funds received, payments made, and balances reflected in the bank and demat accounts. Reconciliation should be an ongoing control and not merely a year-end exercise. The trustee also supports audits, tax filing, and regulatory or stock exchange reporting by providing accurate transaction data and documents relating to the trust. However, the allocation of responsibility should be clearly documented. Appointing a corporate trustee does not automatically transfer every legal, tax, accounting, or disclosure obligations of the committee, or the professional advisors to the trustee. Fourth point.
Actually, we have to be shorten the presentation. Okay.
Yes, sir. Yes, sir.
Just
I
because
just
yeah.
yes, sir. Fourth point is the fourth role is to provide continuity over the life of the ESOP scheme. And ESOP trust may remain active for many years, covering several grants, vesting cycles, exercise, corporate action, employee exits, changes in the company's ownership or listing status. During this period, individual trustees and the company's HR, finance, all the other teams may change, but a corporate trustee can preserve continuity throughout the institutional records. We can have the standard operating procedures, designated backup personnel, and a central custody of documents. Administration is therefore less dependent on the memory, availability, or continued employment of any one individual. A structured team can allocate work, maintain, review controls, and continue processing even when the particular relationship manager or authorized signatory changes. Fifth point is stakeholder coordination. So here the corporate trustee has to coordinate with all type of stakeholders. We have to coordinate with the HR, finance team, payroll, tax team, legal team. The trustee often becomes the operational point through which these inputs are brought together for execution. For example, the trustee may coordinate tax documentation and deduction under the process agreed with the company, but should not provide any personal tax advice to the employees unless separately engaged and qualified to do so. So similarly, it may highlight a mismatch in vesting data, but the final determination of vesting remains with the company or the committee. Why should you choose the right corporate trustee? So you have to see whether to conclude, the practical value of a corporate trustee lies less in a single transaction and more in the discipline applied across the entire life of the trust, acting only on the valid authority, protecting and reconciling trust assets, maintaining the audit trails, ensuring the continuity despite any changes. Companies considering a corporate trustee should assess that the actual needs of their scheme and the trustee's capability rather than treating the appointment as a brand exercise. They should also check the company is good with the transaction frequency, has handled what kind of uh, transactions, has an internal administrative capacity, what is the control environment, how do they manage the data, and escalation process. And also, you have to check clearly on the fees and responsibilities. A corporate trustee does not replace the company's governance structure or professional advisors. When the scope is clearly defined and the trustee has appropriate systems and capacity, it can provide an institutional framework that supports accurate and timely and well documented administration of the ESOP trust. Thank you so much for your time. That's all from my side.
Thank you. Now, Bhakshari, just one question. So, are you seeing that people are more coming for the trust route or something else which is happening? What is the trend?
Yeah, so I can see that many corporates are now moving forward to a trust route. I think, as everybody has explained, and everybody here now knows the importance of why should one go and take a trust route then a direct route. Why it becomes easy for the corporates, especially when the number of employee increases, there are larger number of exercise happening. So in that case, I think a trust route is really a best option. And again, a corporate trustee for the same will ease the activity, and everything will be in place. So I think now, I think for this past 2 years, I have seen that many companies are now moving forward and taking the trust route rather than the direct route.
Okay, okay. Now let's take up some questions because we have received. So I will ask one by one. So anybody wants to add something, please add it. But very short answer we have to give. Can unlisted company with implement trust route, can the trust acquire shares from existing shareholder and not fresh allotment? Moini?
Yes, even the unlisted companies can go for the trust route and can acquire share from the existing shareholders. That's not a problem.
Okay, anybody has a different view, just raise a hand and then we'll move. Question for later part of the session, if it is possible, India as per applicable law that trust can sell the shares and pay the money to grantor after deducting applicable tax. What is your view, Akshay?
Yeah, definitely, sir. I think and Moini has briefly touched upon on the cashless exercise as well. And I think this is one of the benefit, once you have a trust, because it can straight away execute the sell transaction and give the difference to the employee. So I think, yeah.
Okay. If the trust ESOP trust acquires shares from the company and subsequent transfer shares to employee under ESOP, does it need to comply with section 89, that is filing of MGT 4, 5, 5 or 6?
No. So it depends upon the structure, that what is the structure of the ESOP scheme and what the placement of ESOP trust in that scheme we have made. So if it is not for the beneficial ownership, this MGT 4 and 5, then it's not required. In the normal practice, we don't require this filing.
Okay. How will trust get the funds for purchase from market? Can company provide the fund to trust without violating Companies Act? Sonali?
Yes, sir. So ESOP trust can be funded through loans for listed public companies and unlisted companies. Section 67(3) of the Companies Act provides an exception to prohibition of financial assistance, allowing a company to provide assistance to an employee welfare trust for acquisition of shares from the market or through primary issuance of shares. So that's permitted.
Anybody has different view on this? Okay. Moini, any other route to pay to the trust to get the shares purchased in the market?
Yes, they can get the funding from any financial institution or any other NBFC who extend those loans against the shares. That is also possible.
Okay. Can you help us understand the process for cashless exercise?
So we have explained, and Akshay has just explained on this cashless exercise, that the employee exercises direct to the trust. Trust will sell the shares, arrange the funds, and set off the entire amount on behalf of the employee and transfer the balance shares to the employee, whatever is left.
Okay. Okay. What is option buyback? Do we have following provision of section 68 of the said purpose? Can companies facilitate cash payout to employee in unlisted company given the RSUs are yet to be recognized in Companies Act 2030 unlike SEBI LODR? So Akshay and Sonali, you have done any type of this option buyback? Moini, you have done? Yeah.
Right. So there is a provision in the Companies Act for the option buyback, but you have to follow the entire process of that. But yes, still the provisions are very much inclined towards the share buyback. It's evolving, but it's not. There is a provision, but you need to plan very carefully for that option buyback as per Companies Act.
Okay. Sonali, you have any view on this?
No, I'm aligned with what Moini has suggested, but I think in unlisted company there was also process of cash settlement if the structures allow, because only SEBI, to my knowledge, only SEBI share-based regulation restrict cash settlement. For an unlisted company, that option is still an open. So there are a lot of companies who follow cash settlement.
But Moini, Companies Act has to change for this because LODR provides Companies Act silent on this.
Yes, because there is no physical shares which have been issued, so the companies that can issue the guidelines which are more streamlined for paying the cash without because it doesn't affecting the balance sheet per se, because the no shares need to be extinguished. So I think the provisions can be made more easier for the unlisted companies for going for the option buyback process.
Okay. Where a company has passed a single board shareholder resolution for granting ESOP to employee of both its holding company and subsidiary company, what is the appropriate corrective course of action? Moni, can you tell?
Where the company has passed a single resolution for granting ESOPs to both. Uh, So the law very clearly says that you have to pass a separate resolutions for the holding and subsidiary. So you have to go to the shareholders again, rectify it, and then you can only extend the benefit to your holding and subsidiaries.
Okay. Akshay, Sonali, or Bhagshri, any point on this?
No,
If you
sir,
have-
totally aligned.
Okay. Now, if ESOP had been granted based on the single resolution, whether the original resolution was legally sufficient or merely suffered from a procedural defect. I think you have given answer of this.
Yes, it's a procedural defect. You have to go for
Okay. Whether section 67(2) is not applicable for private limited company irrespective of criteria specified in 2015 circular, as section 67(2) specifically said no public company, and whether the company is not required to follow the company share capital debenture rules 2014 provision of money by company for purchase of its own share by employee or its trustee or the benefit of the employee. Moini.
Yes, it's not directly be covered under the 67(2), but it is covered through the other sections. So whenever the company, private limited company going for funding to the trust, they have to look for the other sections of the Companies Act.
Okay. How is the taxation done in trust for share purchase from secondary market? Let's say 500, but given to employee at 100. Exercise price bill trust book a loss in ITR. How is company treating this loss happening in the trust?
Yes, for the taxation purpose, trust is always be a separate legal entity, and whatever the capital, the trust has to book their capital loss in their book. And because the company that loss again, because the trust is a extended arm of the company only, so by the accounting standard also, the books of the trust need to be merged with the company's books only. So that's the separate one, but for the taxation purpose they have to book the capital loss in that case.
Okay. So Akshay or Sonali, you have faced any problem relating to this type of taxation?
Not really. We went for a primary acquisition, so that's something we are yet to.
Okay. Whether same trust can act as a trustee for several corporate ESOP scheme, Bhagishri?
So we create an different trust for different ESOP schemes.
Okay, Mohini, you have any view on this?
No, the one corporate trustee can act for various corporates at the same time.
Okay. Whether at what value the promoter can transfer its shares to ESOP trust?
So first thing, very much clear that here the Companies Act doesn't restrict any kind of transfer from promoters. So there is no restriction on the value of transfer. The value of the transfer always be governed through the income tax provisions. So because it's the transfer from the promoter to the trust as a free or as a gift, it will be treated as a not a valid gift, because income tax doesn't allow these transfer to be exempt completely from the income tax. So whenever the promoter is transferring the shares to the trust, they have to consider the taxation guidelines of 11 UA or some or other guidelines of income tax to determine the value of transfer.
Okay. If trust has been allotted more than 5% of share capital to the company from the primary issue of shares by the company, does it trigger SEBI SAST disclosure?
No, it's a non-promoter, non-public trust, and the maximum it can hold only up to the 5%. So this trigger will comes when the acquirer is going to acquire a substantial or more than 25% or 26% stake. So here the trust will not going to get impacted to the SEBI SAST.
Okay, Sonali and Akshay, have you faced this type of problem?
No, I think in our case, it's more of secondary acquisition, so there's no primary issuance per se.
Okay. Now, Sonali,
Sorry. Yes.
do today's employee value liquidity and wealth creation more than simply receiving ESOP grants?
Absolutely, sir. I think especially in new age companies, because they also work from the same motivation that the founders do. So they look at long-term value creation instead of just looking at the entire package what they are getting. So yeah, we do that.
Okay. What are the operational challenges surprise you most after implementation, Akshay?
For the trust. So, sir, I think operational challenges, I would just say, the administration or the operational mechanics, as I said, multiple schemes managing the inventories and, future grants, and, to manage the, if the trust would have to buy the shares, basis the grant. So I think the planning and the inventories, that's the only thing. Rest, everything, I think it's seamless here.
Okay. Bhagshri, how does independent trustee balance interests of company, employee, and shareholders?
So whenever a employee gets the ESOP, obviously he wants his ESOP to be at a place where it's trusted. Suppose an employee wants to leave or wants to exercise his option, so he, instead of going to the company and following up with the HR, this that, so it will feel that it's with a one particular trust and we have a trustee for that. Same way, the company does not want to go to each and every employee and be behind the back that you want to exercise, fine, I'll do this, that. And the operational activity in a trust is huge. Like, you have to get your TAN, you have to open your demat accounts, everything has to be taking place. So keeping all this in mind, everybody feels that there's a good scope of keeping a trustee so that the operational challenges are reduced and there is less error.
Okay. Okay. Moini, having advised company across industry, what common triggers indicate that company has outgrown the direct route? I mean, how they should shift to the trust route? What is your view on this?
So the first important point when the company start looking forward for the trust route is, like just Sonali has added, that the employee base is much larger, and then the frequency of exercises have increased. So the administrative challenge for going for the allotment monthly or fortnightly, whatever be the case, it's very difficult to manage. Then the ESOP trust will help them to reduce all these complexities. Second one is definitely the secondary acquisition. Now the companies are moving toward no more dilution for the ESOPs. Already the capital is very much sufficient. Then this ESOP trust route is again becoming very important. And the company is unlisted one. They are providing a liquidity channel through this trust route, irrespective, without involving the promoters. So then it makes the company to think for the ESOP trust.
Okay. Which sector is adopting trust route most rapidly?
We are seeing every
What are the major mistakes companies should avoid while shifting to trust route?
The major mistakes which the company should avoid is that if the company already have a direct route, so they must be very much clear that how much they are going to allot of fresh equity to the trust and what they are going to acquired from the existing shareholders. So that is the very much clarity the company should have before starting this shifting process. And whatever the grants already they have made, they have to think it that to what extent the exercises have been made. So that also be a considered. And another one important is now the trusteeship. Like like we have said that there are individually 2 trustees are required, and many of the directors and the key employees cannot become a trustee to the trust. Then the companies should, before having any decision on the trusteeship, then they have to look down for the people who and all the employees can rely. That's the reason the corporate trusteeship is increasing to have those trust maintained among the employees.
Okay. Moini, Bartika, you just tell me from the implementation perspective, what do you companies face the maximum operational difficulties? Very short.
I guess what I feel, the bifurcation of duties, the HR, compliance, and finance all are together involved in everything. No person has a specific data available as per their requirement. So data maintenance and the distribution of, I guess, the duties is the main factor that should be cared of.
Okay. Moini, is SAR scheme is vague in India presently, and how does it differ from ESOP?
No, SAR is very much prevalent nowadays, and SAR is a very well-established form of ESOPs only. Here, the company is, instead of giving the 1:1 ratio of allotment of equity, they will first calculate the appreciation which the share has gained over a period, and then that can be settled either in the form of a cash or either in the form of a share. So SAR is a very well-established practice in India now.
Okay. Can you please brief on process on establishing of trust? For example, you can take South Delhi. You have taken South Delhi. Moini, very shortly, just tell this point.
So for setting up any trust, you need to first find the trustees. Then you have to frame a trust deed. You get the things approved through your board. And then you have to take the shareholders' approval for setting up the trust, for getting the approval from the shareholders for extending the fund to the trust. And then once all the approvals are done, you have to go for the registration of the trust with the proper judicial authority. And once that is done, then you are good to go for implementation of the scheme through trust.
Okay. So I think last few questions I'll just take. It's a rapid round. Immediately you have to give answer. Is trust route becoming a governance tool rather than merely an administrative mechanism, Akshay?
Yes.
Okay. Is trust route easily suitable for a startup, unlisted company, Moini?
No, it's suitable even for the unlisted companies. Yes, it is suitable, subject to certain conditions.
Okay. Bartika, does the trust route improve employee liquidity compared to direct route?
Yes, absolutely yes.
Sonali, if you can give answer, how should company decide between secondary acquisition and fresh issue of shares? Moini, you just give answer.
To the extent the company doesn't want the further dilution, to that extent they can go for the secondary acquisition, and if that doesn't the case, then the company can go for the primary allotment.
Okay. Akshay, how should companies decide? How do investor and proxy advisory firm view trust-based ESOP structure?
So I think, sir, from a proxy perspective, they look at more dilution, while the trust route, if it is from a secondary, market perspective, I think, they would be more privy and supportive of this, because
Okay.
ultimately they are against dilution.
Suppose you have to suggest MCA, SEBI, or CBDT some related test, this trust related issue of ESOP. What suggestion will you give?
Yeah, no, thanks for asking this, sir. So I think so. There is one, specific section, which section 67 3B, which we just discussed, and there is a limit of, up to which the company can fund the trust, which is 5% of paid capital. While this provision has been there from a long time, I think when the companies who are looking at funding trust and their large employees, sometimes this limit can be a restrictive, because ultimately this is the maximum limit, and there is no provision by which you can even increase this limit by way of shareholders approval. So I think there could be some way that this limit can be increased, maybe by way of shareholders approval, whatever.
Okay. Now, because we have already crossed timeline, so this is a time to close. So I will start with Bhagishri about this concept in 30 seconds, and then we can ask, yeah, your view. Unmute yourself, please.
Yes, my view on what? Sorry.
Your views on this particular trust route.
So yeah, as I said, that trust route is much easier, simpler for the companies as well, for the employees as well, for the tracking, uh, and it's very systematic. So I think the trust route is the best option. And if anybody gives me an option for direct or trust, I would surely tell them to go for a trust route.
Kartika,
So I would say that if a loan is a fuel, a trust is a vehicle. When both of them are combined together, we can achieve a destination, that is the employee ownership.
okay, okay. Akshay,
No, I think, sir, while I've seen this, trust route from last many years, I am more privy for trust route, and definitely, I think is more beneficial for the companies as well, because share capital and dilution is something very close to promoters now. So therefore, it's a win-win situation for both of them. Yeah.
okay, okay. Moini,
So if planned and implemented properly, the trust route can offer a greater flexibility and provide a benefit to both employer and the employee.
okay, okay. I think, thank you very much, all. Thank you, all my participants. Thank you, my speakers. Today's discussion not only demonstrated that trust route is not merely another method of implementing ESOP, simplified, effective, and can resolve so many governance issues and settle various things. In my opinion, if this is one route, the ESOP is not only giving benefit to the employee, but creating a ownership. So by doing this, we are going first more ahead of evolution of employee ownership in India, and we are going closely. And the important point is today, not only startup, not only listed company, the unlisted companies are also going for this through buyback route and other thing. And next is that all other listed companies, those who are not doing this, they are identifying that ESOP is identified as a ESG route, whether you are carrying your employee or not. This is one part. So this point will be more and more encourage people to do. And in any organization become large, governance become more sophisticated, and employee increasingly increasing and seek long-term value creation. And then you want stability also. So the company will have to think beyond issuing option and start building sustainable ownership ecosystem. That is their aim. So we have seen, I have given my presentation, generation 5, we are going ahead. Now, next generation, next time is that every employee is a part of the ownership. And if it is happening, then the problem of sustainability, problem of growth will always be uh, ahead of all these things, and people will follow that yes, my company is growing because my employee are stick and satisfied. I thank all the distinguished speakers sharing their practical insight and all participants of being the part of this discussion. On behalf of corporate professional, I once again thank you everyone. And with this, I'm closing this session, but we will meet again on next Friday, 7th, at the same time, 4 to 6, with a new topic, LODR, the implementation issues.